Perfect. All right. Once again, a very, very good afternoon to all of you and a warm welcome to our Investment Readiness Workshop series. And for those who are new to YSpace as well, I'm Alina Ali. I am the Program Officer at YSpace and I will be your facilitator for today's session, as well as the rest of the Investment Readiness Workshop series. For those of you who are joining us for the first time, a quick introduction of what we do at YSpace. We are York University's entrepreneurship hub, and we have several incubator and accelerator programs designed to support entrepreneurs from different sectors. The technology and food and beverage portfolios are one of our biggest portfolios, but we also run two diverse streams, the YSpace Ella program that supports women-led businesses and the Black Entrepreneurship Line stream for Black founders. We do a lot of educational workshops. We provide one-on-one mentorship. So if you want to learn more about our programs and services, there's a QR code on the screen for you to scan. I think the best way to learn about our programs and services is by scheduling an idea consultation. So the QR code will give you an opportunity to do that. You can also remain updated with our events and programs by following us on our socials. So you can follow us on at YSpaceYU. I'm going to leave this slide up for a bit so you can scan easily. Now coming to the Investment Readiness Workshop series. This is a four-part workshop series, and with it, our ultimate aim is to provide you with the essential knowledge and skills to prepare your startup for investment and the fundraising journey. And we're extremely lucky to kick off the series with Galen Udell's session on fundamentals of startup financing. Galen is the investment program advisor at YSpace, where he helps startup founders through the fundraising process, helping them assess their KPIs and business model to ensure that it matches the financial ask. Previously, Galen was the executive director of York Angel Investors, where he provided a very strong connection between entrepreneurs seeking early and mid-stage capital to savvy investors. Galen has been an entrepreneur himself, so he understands both the founder's perspective as well as the investor side extremely well. Galen, we're super excited to have you lead the session, and I welcome you to begin the workshop.
Great. Thank you very much, Alina. I appreciate it. And thank you very much to everyone for taking out your time at lunch to join us here. I'm just going to share my screen and go. All right. So we were having a little bit of technical difficulty with my PowerPoint here, so hopefully we've got this. But basically, what we want to try to do is to go through really the fundamentals of startup financing from the perspective of understanding the mindset of an investor. Many founders that I see that come in really have some challenges around why didn't I get funding, or really understanding the process around getting funding. So what we want to do today is kind of go through sort of what motivates an investor to help you understand that. Also to understand, what investors might be interested in. Why might they be interested in your opportunity, or why might they not be interested in your opportunity? And also then to help you to prepare for what you're going to have to go through if you do decide to go through growth funding. And so that's really the goal of what we're going to try to get through today. So really, starting off with the investor mindset is that you've always got to be thinking about the fact that no matter what you're doing with your startup, you are going to be pitching. So whether you're pitching for sales, which is always to grow your business.
Sorry to interrupt. I think the issue is still persisting. We're still seeing your notes. So do you want to just share the PowerPoint as is, rather than going into presenter mode? I think that would be a little better. Yeah, I think this is better.
All right. Okay.
Galen, I think there was a button you can click that changes the view.
Yeah, we tried doing that, but it's not happening. That was the technical issue.
That's all right. We'll deal with this. All right. So basically, you're pitching either your business to grow your business, right? Or you're pitching for resources. So that's going out to universities and trying to get students to come and join your team, or whether it's going to events and trying to encourage people to come and join your team. You're trying to pitch your organization. Well, it's no different when you're looking for investors. When you're looking for investors, you're trying to pitch to investors. And although the story is somewhat similar in each of these. The investment pitch is one that most founders don't think about, is how do I pitch to an investor, in the sense of what am I trying to pitch to them? Am I trying to pitch them my product? Am I trying to pitch them all the great things about my organization? It's actually a combination of all of those, because an investor is looking for something entirely different in wanting to be part of your organization. And so there's different ways that you want to be pitching your organization. Pitching to investors is very different from pitching for sales or pitching for resources. So let's start off a little bit around dispelling the myth about lifestyle companies. This is one thing that we often hear is people get, I don't want to be a lifestyle company. Well, the reality is there are differences, and there's positives about being a lifestyle company, and there's differences in being an investable company. A lifestyle company is a company where you're going to build this thing at a much slower rate. It's organically growing, but this is something where you end up owning 100% of the business. There's a very flexible exit strategy around that. You can grow this business for 10 to 20 years. You might have a private equity come in and take it out as you grow your business. You determine when and how you want to exit your company. These are probably some of the most well-off people that you would know are people who have lifestyle companies. And that's because they built them themselves, but they build them at the pace that they wanted to build them at. Versus an investable high growth company. What we look at for an investable high growth company is these have to be companies that are going to generate revenues of a minimum of $20 million. And they need to be really companies that are looking at 100, 200, $300 million revenue companies. That's really what a high growth company looks like to an investor at an early stage. The investors want their capital to grow. They need that capital to grow. There has to be some level of understandable exit strategy around that, because at the end of the day, as an investor, I'm looking for how do I make my return. No ifs, ands, or buts. That's the goal of a private investor, particularly at the early stage, is they need to understand, how do I get my money back out of this? And I don't want this money to be just sitting there for 15, 20 years doing nothing but funding a company, right? So they have to have some level of knowledge of where that exit can be. And they have to be thinking about that at the very beginning, when that's part of their process of understanding, is this a company that I want to invest in? How will I get my money back out? And so there's an element around what that investable high growth company has to look like, because it's basically a relay race. Once you get into that funding cycle, the early stage investor has to come in. They have to think about, how does that move to the next level of funding, to the next level of funding, to the next level of funding. And so if the early stage investor can't see that, then that's going to diminish the opportunities you have as far as getting investors on board. And so that's, think about that as your company when you're starting to set it up and starting to build your business, is think about, what do I want this company to be? How do I want to picture myself as part of this company? Do I need this high growth capital to make this thing work? Or can I actually build this slow and steady over a period of time, and maybe use different sources of funding, like a bank, which is going to be even though interest rates sound high, it's a lot less expensive to pay interest than it is to give away large portions of your company, which is what you're going to have to do as an investable company. So that's one of the things you need to really be thinking about right at the beginning of your journey, is what kind of company am I trying to build, and where do I want this company to be in 5, 10, 15, 20 years from now? So as an investor, investors have choices, right? So when I want to deploy capital for growth, there's generally two ways that I'm going to go. I'm going to go market investing, or I'm going to go private investing, or a combination of both, right? The majority of investors out there really only do market investing. There's actually a very small percentage of investors that do private investing. And I'll go into the reasons for that. In that market investing highly liquid, right? I can create a trading account at TD or at Interactive Brokers or somewhere else, right? Robinhood. I can get in and out of stocks quite easily. It's far more predictable. Typically you're going to get returns that are, somewhere between 3 and 7% overall in your portfolio. These are companies that will, look to double their money over a longer period of time. And there's going to be some fees involved in that, right? So that's market investing. That's 98% of the investors out there. That's what they're into, is market investing. Private investing is a very, very different animal. And this is an area where people come in, they're looking for much faster returns on their capital. It's higher risk. They want a higher return on it, but they also know that there are also going to be opportunities for them to lose their money in the private investing world. There's not always a guarantee of return. So it's a very different program that people want to look at in there. But part of it is there's an asymmetrical information balance that's not there when it comes to market investing. In market investing, I generally don't get access to information ahead of time about a company. I'm getting some speculation about what it is they're going to do. There's documentation that they have to put out as far as market information, but you can't trade on inside information, right? You can get thrown in jail for that. But when it comes to private investing, I get to know quite a bit about an early stage company. I really get to understand who they're targeting, who their customers, who are some major things about them. So there's some elements there that you get to know as a private investor that you don't really get to know at the market side. Now, that doesn't guarantee a win. It doesn't guarantee that you're going to have a company that's going to exit. Everything could fall apart. In most cases, they do. But it can be life-changing money for an early stage investor, right? So if I get a 1,000x, a 10,000x return, that's a massive amount of money, right? So there's a reason why people come into the private investing space. But again, it's very, very few people that really will want to go into the whole private investing landscape. So understand it's not for everybody. It is a very different type of personality that goes into that private investing. And a lot of that is because of that risk reward side, right? So we also understand that we're going to have way more losers than we're going to have winners. Every time we go into an investment, we think we're investing in a winner. We wouldn't be investing in it if we think it's only going to be a small return. We want to think that every company we're investing in, everyone that we're going to write a check to, has this opportunity to be a grand slam. The reality is that the majority of them fail. They go to zero. So we need those high exit numbers. We need that high multiple of a winner in order to offset all the losses that we'll get out of our portfolio. So again, that's that mindset the investor has when they're coming in and looking at these early stage investments, is that they are evaluating your company. In their brain, they have to be thinking, can this company make me a massive exit from the investment that I made? And so if the investor doesn't see that, if you can't paint the story for them as to how do I get to that big exit, how do I keep the baton moving up the line, am I the founder that can run this thing for the next 6 to 10 years and make it a $100, $200, $300 million company, then chances are you're not going to get the investment, right? So that's part of the basis of how you have to build your story and what you have to do if you're going to be going down that private investing world. So, we're looking for massive exits, right? We only have to be right once, really, to have a massive exit, but we want everyone we're investing in, we think is going to be that massive exit for us, right? So that's the area you have to think about of the investor, where their brain's at when it comes to evaluating opportunities. So your opportunity versus other opportunities, because there's going to be, if I'm in the private world, I'm not just looking at one opportunity. I really need to build a portfolio, of 20 to 30 to 40 startups in order for the numbers to start to work, in the sense of how many potential winners I have. If I'm only investing in 5 or 6 companies, chances are I'm not going to get any winners. If I'm investing in 40 or 50 companies, I have a greater opportunity of having 2 or 3 that are going to be successful. Well, in order for me to invest in 50 companies, I probably am going to have to go through 400 to 500, maybe 600 opportunities to find the ones that I want to invest in, right? So there's lots of competition for the dollars that are being spent by the investors in this world. So when we think about the private investing landscape, there's a lot of ways you can go out and get money in the private space, right? So starting in the top left, is that top left is sort of at the concept of your business. You can look at the bottom here, product market fit, growth, scale, exit. That's really the maturity levels that you have as an organization. So starting at the top left, higher risk opportunities. This is where you're really going out and you're in pitch contests, you're dealing with friends and family, and they're helping to get you funded at that concept level. You're not going to get a whole lot of individual investors coming in at that stage. You may get some, but it's more likely you're going to get funded through those pitch contests and friends and family rounds. You start to get into the individual investors, a little bit beyond that. You can also tap into the government money, whether that's OCI, BDC, SHRED. So there's a whole bunch of sort of government and quasi-government sources of funding that come in at that very early stage. As you start moving along the line and the amounts of money being invested, you start to move into sort of the accelerator and startup funds that are out there. So there are accelerators, particularly in the US, that will pay you a certain amount of money. They'll take a percentage of your company, right? So they're acting almost like an angel group in some ways. In return, they're giving you some services. You see that much more in the US than you do in Canada. And they'll sort of start investing into some higher levels. Likewise, you have angel groups that will start to come in at that level. The angel groups typically don't get involved, until the checks, the company's trying to raise more than $250,000. They don't want to jump in and fund into you trying to figure out your product market fit, right? Or the concept of what it is. They'll come in at the sort of, okay, now we want to build into product market fit and then beyond there. You also have syndicates of angels, so things like Angel List, where there's going to be SPVs, special purpose vehicle, groups will come around. They're one-time shots versus an angel group. They're seeing opportunities coming in on a monthly basis, and that group will look at opportunities, and individuals from those angel groups will invest. Versus a syndicate it's kind of the opposite of that. A group of people come together, write one check under a special purpose vehicle, and write that to your organization. And you also have small venture cap funds, right? They start to come in around that $500 to $3 million stage. But what they're looking at companies that are really much more into, okay, we've got product market fit. We're now trying to figure out how do we tune this thing and how do we move toward growth. Then once you get into that growth stage, now you're getting into the syndicates of VC funds or bigger VC funds. So you have to look at the VCs that are out there and understand, if you are talking to VCs, what type of VC am I looking to, right? Where are they investing? How does their fund invest? What's the thesis behind what it is they're doing, right? So each of those funds will fund in a different way, and you have to understand who those venture funds are, so you make sure that you're spending your time appropriately when you go out to talk to them, right? You don't want to be spending a bunch of time talking to a large venture fund that's really not interested in funding a low, a very early entry stage startup that maybe has got their first checks and now going to raise your second ones. You probably need to be looking at a small venture cap fund versus a larger one. And obviously, along the process here, you're de-risking the organization. So many of these larger funding groups don't come in until a risk is much lower. By the way, when I say lower risk, that's still a really high risk company when it comes to something related to public markets, right? There's a great chance that a company that's still raised $5 million to $50 million could go out of business, right? So there's that risk level is still high, but when it comes to private investing, the risk, most of that risk has come out. The return will also be a lot lower for those companies coming in at those later stages. So the other thing you have to think about is that we as investors understand what the startup development curve looks like, right? So at concept, your company, everything's all exciting. You go in, and if you get funding, you actually go into this thing called the valley of death, right? So you're trying to figure out product market fit. You're burning more capital than you're bringing in the door. And this is generally where most companies will fail in the startup world, is after they've received funding and then they're moving through this valley of death. This is actually something called the J curve, and it's a very known thing in the investing world. And so if once you get that first revenue, start pulling out of the valley of death, right? That's really where we want to see that acceleration of the company going along, and they're now getting the next levels of funding. Problem is many times we see companies coming in, funding, and they start talking about, well, we want to get money to grow and scale, but they're still really at the concept stage, and or they're trying to work toward product market fit. So as an investor, that's when the red light goes off on the side of their head, going, wait a minute, this startup really doesn't understand what's required for them to use their capital efficiently. And think of it as, you're building a tricycle, and you want to move that tricycle to a bicycle with training wheels, get the training wheels off, be able to ride the bicycle. You want to now get on to, turn it into a motorcycle. Now I want to turn it into a put some jets on the side, put the right level of fuel into it, and then turn it into a rocket sled and get it off the ground, right? If you start trying to pour gasoline into a tricycle or a bike with training wheels, it's going to blow up, right? You're going to plow into a wall and never survive. And that's in our heads, that's what we're thinking about, is how is this startup going to deploy their capital? Are they going to use it wisely? Are they going to burn through this capital too quickly? If they're talking about growing and scaling when there's still a product market fit, that's somewhere where we will say, okay, we're not willing to fund this, because the founder actually doesn't really understand where they are on their startup development. So it's really important to understand when you're pitching to investors, how you're pitching your opportunity, and make sure it aligns with where they would see you in the startup development or growth stages of your organization. So let's turn a little bit to the types of angel investors who are out there. There's a whole different type of group of angel investors who are out there. There's things called lone wolves. These are people that go out there, do their own investigating of opportunities. They will troll through different areas and different networks to try to find opportunities, and they go out and they do their own thing. There's informal angel investment groups that are out there. These are, typically 8 to 10 friends that have gotten together, and they're bringing opportunities in, and they're evaluating those and going through those kind of things. A lot of times, again, they'll be using things like AngelList and other groups that are out there to be able to find opportunities. There's the not-for-profit and professional angel groups. That would be things like Maple Leaf Angels, York Angels, Equation Angels, right? These are all not-for-profit groups in Canada. There's angel syndicates. So these again are things like AngelList, where these things come together, and then someone will post an opportunity, groups will get together and create an SPV around a particular opportunity. And then you've also got incubators and accelerators that, again, will act somewhat like angel investors in some way. And then there's something called super angels. These are people with very, very deep pockets, generally focused in 1 or 2 vertical markets, and will probably make 8 to 10 investments in a particular vertical market because that's an area that they specialize in, and they deploy usually very large amounts of capital into those opportunities, right? And find more of those in the US than you will in Canada. Characteristics of all of the angel investors, right? They're usually high net worth entrepreneurs. They're making investments anywhere between $10,000 to $1 million, fairly financially sophisticated, have business experience. They really are lifelong learners, and they want to pay it forward. You as a founder need to think about, what are the characteristics of the investors I want to have? Who do I want to have there on my cap table at the very early stages of what's happening, right? Because we as investors, if we're the first checks into your organization, a lot of times we're investing because, again, we might have really good business experience in the vertical market you're in. That also means we might be phoning you on a regular basis and giving you our input and trying to make introductions for you and trying to do things. You as a founder have to think, do I really, do I want that? Do I need to have another voice on my shoulder telling me what to do? In some cases you do, some cases you don't, right? So you, as bringing on funding, should also be thinking about, who are the types of investors that I want to have on board at the very early stage of my journey, and how much do I want them to be involved in what it is that I'm doing as well, right? So think about the characteristics of those angel investors who are out there, and how do you want them to be part of your business? Because again, they're writing a check to you. It's very personal, and therefore sometimes we feel that we want to get involved and try to help out wherever we can. And in some cases, that's if it's taking away from you running your business, it's a very, very hard line that you have to follow, in trying to run your business and deal with your investors. And again, the level of investment, you can have passive investors, you can have active investors, you can have those who want to be part of your board. There's what's called a lead investor. Lead investor is often the one with the biggest voice. They're the one who has rallied others or is the first person to write the check, and therefore they feel that they have an outweighed position within your company, right? So think about where, what type of investor that you want to bring in. It's quite critical in that decision process, especially if you have a really good startup. You might be in a position to actually decide which investors do I want on. In most cases, you're scrambling to get money, you're scrambling to bring in money. So sometimes you don't have a choice as to who's going to be on your cap table. You're just looking to make sure you can secure that $500,000 worth of funding you need. But if you actually get oversubscribed, that's an opportunity for you to now start thinking about which one of the investors do I want on the cap table, or which ones don't I want on the cap table. So, again, just to wrap up on that, what we're looking for, as an investor, we're looking for strong, committed founders. The number one thing when we would do surveys of our investors at Growth Angels is we would ask them, what are you investing in? What's your real purpose for investing? And the largest number that came back was always, we're investing in the founder. At the very early stage, that's really what we care about, is who is the jockey, or who's running this company, how committed are they somebody that we see being able to shepherd this company for a long period of time? We know the idea will change, we know the company will change, it has to change, because you're going to be getting feedback all the way along on your product development, and therefore, if your company's not changing, that's actually not a really good sign, because it probably means you're not listening to your customer very well, right? The idea you have to begin with is, really meant for early adopters. But in order to be able to scale your company to the general population, you need to change your product, you need to change your offering for the general public, and therefore, what you're building will change. But what won't change is the founder won't change, or the founding team, right? So that's really the element that we're investing in at the really early stages. Who is the founder, and how committed are they to what it is they're doing, and how will they deal with feedback? How big is the problem you're solving? And is it innovation or an innovative product that you're bringing to the market? Is it something new? Is it something different? And how big is that problem? Is there a high growth potential to what it is you're building? If it's not a really high growth potential, again, will it get to that $50, $100 million threshold that the VCs are going to need to start seeing in order for them to want to invest in? Is it a business model that we understand? Is it something that when you're building this, that you can explain the business model, that we can understand it, that it's something that is repeatable, or is it something really novel that we're not sure is going to take off, right? Is it the right kind of business model? Do you have a sustainable competitive advantage? At the early stages, we need to know you have a sustainable competitive advantage. Otherwise, other competitors are going to come in if you've got something really interesting. If other competitors can come in and eat your lunch, right, you can be out of business very, very quickly. So, if you have that sustainable competitive advantage, we want to know about it. We want to be able to see it and see it in action. Do you have existing customers and partners? Have you signed them up early? How long do you have them for? Are others doing the same thing you're doing and signing up those? Are those customers or partners looking for and evaluating 5 or 6 companies, or are they only evaluating you? What's the quality of your management team? Who are the previous investors that are on your cap table? Is there a realistic and alternative exit strategy for what you have? In conjunction with the high growth potential, and is it a big problem? Is there a global prospect to this business? Can this go globally? You don't need to explain that right away. That's something the investors will start to think about and look at themselves to understand, hey, do we think this has that global opportunity? And then the last thing is sort of, what are the business practices that you have within your organization? In most cases, you're very early, coming in and seeing angel investors. So the last 3 are not as important to us. We'll look at those and we'll make those evaluations. That's not something we totally expect the startup to have thought through in a lot of cases. But when we have a conversation due diligence, we'll start to bring up these elements in conversations and due diligence. So talking about due diligence, we'll go into the investment process, right? So when you go through this process, you have to be prepared at least 6 months before you need funding. And, a lot of cases, a founder will ask, well, why does it take so long? Well, it takes a long time because there's a lot of steps that have to go into this. And when you as a founder come in and try to, raise funding in 2 to 3 months, that's a really scary sign. That if you're going to be out of business in 2 or 3 months, and that's when you start the funding cycle, that's, as an investor, again, sets off alarm bells that you weren't prepared, you weren't thinking about when you need the funding and going through the right thing. So there's that 6 months is really when you want to be, getting yourself prepared, because you've got to go in, you've got to introduce the opportunity to the funders. There's the initial meetings. You've got to figure out, who am I presenting this to? Do your research as to which investors are out there that I want to start reaching out to and sending information to. When you go through the process, you want to get the go or no go very, very quickly. You don't want an investor stringing you along for a long period of time, and that is something that a lot of investors will do. A lot of them don't like to say no very quickly, right? You want to get them to say no quickly so you can go on to the next one, right? And not have to worry about spending time with that investor. Likewise, if I'm interested in your opportunity, I don't want a bunch of tire kickers. You spending much time with a bunch of tire kickers. I want you to be finding who else can invest in your company to move this thing forward and get the checks written quickly so you can move on and start building your business. Be prepared to sign an NDA if it's required, or have an NDA ready to give to an investor if you believe it's important for them to have that. Due diligence, due diligence can, be as much as, I'm having a cup of coffee with somebody, explaining my business to them, and they buy into it and they go, I'll write you a check, right? That doesn't happen very often, but that can happen. That'd be the due diligence they might share or, want to go through because they really believe in you and they believe in what you've just told them. To, angel groups can take a month, 2 months, 3 months to do due diligence, right? And so, because that's going through business plans, it's going through financials, it's back and forth, it's conversations, it's digging into your IP. There's a lot of things that can go into a due diligence. So you have to be prepared that can get strung out for a long period of time. So those are, this list here of different things that you have to be thinking about in the process of going through funding. All of these could come into play, or just a couple of them, right? So it's not a definitive list, but you have to be prepared that all of these things can come into play, which will take up the amount of time, up to 6 months, again, to get your checks written and money into the bank. So, if we think about an angel group, if we go to the last point here, number 5, right, which is kind of investment. So if I were to back that up and say, okay, I want to get a check written, this month, in February, or sorry, in June. Well, what did that take to get there, right? Well, I was probably in negotiation with that startup for a month and a half doing due diligence just to get to the point where a check would be written. So we're at the beginning of May when I probably started going through the due diligence cycle. In order for that due diligence cycle to begin, you probably presented to an angel group no earlier than, you probably presented to them at the end of April, or maybe even the end of March is when you presented to them. In order for you to get in the pipeline to have been seen by an angel group in April or March, they would have had to go through screening committees, a month before that, and then a month before that, all the applications. So you're talking about February, you probably would have submitted an application to an angel group. They would have vetted you through the screening process, put you in front of their investors in March or April, and then started doing due diligence in May to get a check written in June. The fastest I've ever seen this happen is 2 months. And that was a well-oiled startup that was very investment friendly, had already had a number of investors on board from other angel groups, or was just trying to close out the end of their round because they had some small VCs involved and things like that. But generally, when you come into the pipeline for an angel group, it's going to be 4 to 5 months from the time you enter the pipeline to the time you potentially get a check written. And a lot of that is just based on the fact that this process that is and this is pretty much every angel group follows this type of process, right or wrong. It does get you in front of a lot of investors at one point in time. It can save you a lot of coffees and emails and pitches to 100 different investors. If you can get into a pipeline of one angel group, chances are you can get into the pipeline of 2 or 3 angel groups, and now suddenly you're in front of 300 to 400 angel investors, in this type of process. So again, weigh your odds around what you have to be prepared to go through in this investment cycle. But that's just a typical process that you go through with an angel group here in Canada. So, the raise fundamentals, you have to, understand what your ask is, right? It needs to be supported by a proper business plan. So when, when we're going through due diligence, if you're saying I'm raising $500,000 and we start to dig into, well, what are you raising it for? And you really don't have a business plan supported by a financial plan. Again, it raises a lot of red flags. We need to understand, where are you spending this capital? Are you spending it in the appropriate ways? How long is this money going to last you for? What are you going to get done with this money, right? So, if you're raising $500,000, what are the KPIs that I want to be able to know and ask you to provide feedback through that 12 or 18 months of, are you meeting those KPIs? So those are things we want to make sure are all in place as we go through the due diligence before we write a check. Want to understand that the vehicle you're raising on and why, like if you're raising on a safe note, or are you raising on a convertible debt? Are you raising on shares? Why? And are you flexible, right? Is there a reason why you want to save over a convertible note, right? You have to have an ESOP in place. If you're going to go through the raising process with angels or beyond that, if you don't have your ESOP in place before you go into the funding cycle, you're going to get stopped with due diligence, because they're going to say, we want your ESOP set up first. The reason for that is, if I've invested money in you and then you set up your ESOP, you're actually now taking money out of my pocket to fund all of the employee share program. We want to make sure that employee share program is set up before we put our dollars in. Otherwise, I've just lost a percentage of whatever it is that I've invested into, right? So make sure you've got that ESOP in place. Otherwise, you could get stuck for suddenly, 2 months or a month trying to get that set up. And if that stalls out, and you now lose your funding because you haven't put that in place, right? So just quick and easy things to make sure you're putting onto your table before you go into the funding cycle. And the other thing is to understand that valuations are a moving target, right? How much you're raising, what you're raising on, and valuation, you should be flexible on all those. You should be working with the funders to understand what's best for both parties. I've seen more deals fall apart because founders get really focused on, I want this valuation. The reality is, it's unbelievably hard to put a valuation on a company, particularly at an early stage. So investors, they want to make sure that you have an incentive to be in the business. So they're not going to try to, take away too much of your business. If they are, that's actually not an investor you want, right? You want an investor that wants you very motivated, and therefore is willing to, put the money in at a proper valuation so they can get their return that they think they're going to be able to get out of the opportunity. But if you as a founder get really fixated on, I want this valuation for my company, that could be a deal breaker. So you have to have that flexibility and understand, why does somebody want the valuation to change? Is the valuation really that important to me over getting a check, right? When we get into the investment process, again, a lot of it, we want to get to know you. That's what we're investing in. Then we get into diligence. We want to understand the cap table, pre and post. What are the terms that you have? Again, valuation. It's more of an art and negotiation than it is a science. I just talked to a startup recently who was throwing out a valuation number and said, well, we got this from a third party. And I'm like, wow, that third party, if they're trying to value an early stage startup, I can't put any credibility into that, because there's no numbers, there's nothing really to back up those valuations, right? At that early stage, a valuation is really, lick your finger, stick it in the air, right? there's really not much you can hang yourself on at the early stage where evaluation is. It's just what feels good between you and the funders on where you should be with your company. Again, these are hard things you have to have ready. You know, what's your business structure? What are your financials? Who's your market and competition? What's your management all about? The ins and outs of what your product or service are, right? What are the details of it? What do the operations look like? What do you have for IP? And then what are the critical risks and problems that you know that are there? You need to disclose these things to investors. They will help you to understand if that's going to be, if there's a risk, they want to understand that, right? Don't hide it from them. Maybe they can help you with taking some of those down, right? So these are the things you want to make sure that you've got on your checklist as you go through and as you get into due diligence. You know, investors, they'll warm up to you a lot more if you have these things already in place as you go through. There's an informal process around due diligence, right? So make sure that you're looking at what each of these are, but the gut feel of the informal side is really important. And then the formal piece really is, you know, that's all the elements we just talked about. So having all of the pieces set out of what the company's all about, right? And then the end goal of the due diligence really leads to, you know, the signing off of the overall deal, getting the money in the bank, and then being able to work with the CEO, right? So on that, we're at 12:50. The rest of this really is just talking a little bit about sort of the what the effects are that are going on in the marketplace. These effects really haven't changed a whole lot over the last couple of years. We are starting to see money flowing back into the startups, which is great. We did see a stop for a little period of time there because of the interest rate rises, interest rates coming down a little, or the thought of interest rates coming down. Money is now starting to come back in that area. So I think that's really, you know, a good thing. We're seeing, you know, some VC money being coming out into startups now. It's really what the angel groups look like. You know, we've got 45 incubators, accelerators, 4,200 active angels in Canada, and about 41 angel groups, and you know, very active in the marketplace. This is what you typically see as a deal flow as you come through, right? So when you think about how many applications are coming in across angel groups in Ontario, it's around 7,500 to 8,000 applications come through. And of that, about 400 get funded, right? So it's about a 5% success rate from coming into the funnel, actually getting funded, right? So it's a very, very structured process that happens across the angel groups. And this is really sort of where we see the funding, where they're going into, the different areas, and the types of funding that you're seeing, from preferred shares to convertible debt, safe notes, common shares, right? So the biggest chunk, convertible notes and preferred shares, are really where you see a lot of the types of funding that come through. And then with that, I know we're running up into a little bit of time crunch here. If people want to stay around, I'm happy to stay around for a little bit longer if we want to do some Q&A. But I'll open it up if anybody has any questions.
Thanks, Galen. This was great. We do have a couple of questions in the chat, so I'll start with those. But if folks, you have questions, you can use the raise your hand feature and I'll get to you. Galen, Abdul wants to know, many VCs say that they don't sign NDAs. How can he manage those conversations?
So in general, they're really, unless you've got something that is really unique, then there really isn't a reason for an NDA. So if you have IP, then your IP is disclosed anyway. So you don't, if you have patents, right? Then that's already disclosed. When it comes to your own, you know, what is the secret sauce of your company, or anything that is vital information that you don't want to disclose, or if you haven't filed for your patents yet, then don't disclose that. You can't disclose that, because once you do disclose that, right, that could nullify your patent application, right? So there's certain elements that you can certainly keep back and not share. And when it comes to that, you would then want to make sure you're having a conversation again with the BC, saying there are elements here that we need to make sure are protected information of our organization, and these do need to go into an NDA, because they need to be documented. And as a funder, they should fundamentally understand that as well, right? That if there are elements that that could hurt their business, hurt your business, they want to make sure that you're doing all the right things to make sure that that information is protected. Because they would certainly, if they were an investor company, they'd want to make sure that you were doing the same thing with other levels of investors coming on board. But in general, your slide deck, your general information about your organization, financials and things like that, the investors aren't going to be releasing that to anybody. There's just no value in it for them. So I wouldn't be worried if that's what you're trying to get an NDA signed for, is general information or your slide deck. But again, when it comes to information that needs to be preserved as part of your IP strategy, then yes, you have the right to say, we need an NDA in order to release this information because it's part of our IP strategy. That's the only stuff I think that really needs an NDA.
Got it. Got it. Thank you for that, Galen. Mina is asking, when you were sharing the early stage funding process slide, she wanted to know if those guidelines are for equity funding or do they also cover debt funding?
So it's on which slide?
It was the early stage funding process when you were talking through all the various, yeah, if you could just go back. Or Mina, if you want to unmute yourself and ask your question so we have more context.
I actually wasn't asking anything specific to a certain slide, but all of the discussions that we've had so far suggest that it's equity funding that investors are interested in. Is there a different process for debt funding, or is it basically the same?
So when you're saying debt funding, do you mean like a convertible note or a safe note?
Yes, excuse me. Yes, or even secured debt. I'm assuming angel investors are always looking for an equity position, so they've got some control over the direction of the company. But I don't know if that's always the case. It's just a question.
So angel investors actually typically are looking for convertible notes. It's again, part of that is because it pushes the real valuation down the road. We know at the early stage valuation is going to be a very, very difficult thing to try to do. So when you're trying to put equity onto an organization, you actually do need to create a valuation, and it's costly. So if you're raising less than $1 million, if you're trying to raise equity, you're going to spend a lot of money on legal fees, and we don't want that. I'd rather every dollar you're raising is going to trying to get your product market fit, right? Move your organization along. I don't want you spending a bunch of money on lawyers. So doing a safe or convertible note is far less expensive. It allows the valuation to be pushed down the road until you've built the organization, built the company, built revenue streams, so there can be somewhat of a proper valuation done. And you're now going to be raising, $1 million to $2 million. Now you can carve out, $100,000 in legal fees to actually capitalize the company properly. So from so as a convertible debt, right? Convertible note is convertible debt. This speaks to exactly that same process. Same thing with the safe. So these are interchangeable when it comes to what we're looking at from an organization for those. If you're talking about debt financing, right, where you might have some assets that you want to then, do a loan against or put something against, that's a very different animal. That's more, there's that's a different process and a different type of investor that gets involved in that. Angel investors would never, that they wouldn't do that. That would have, that's going through usually a debt financing solution that would deal with that. Does that help with the?
It does. And as a lawyer, I agree with you that we want to keep legal fees down at the front end, but there are some benefits to properly creditor proofing from third-party creditors at the front end that you can't take until you're at least 3 years in otherwise. So there is some advantage to doing a proper share structure at the front end. And, I'm happy to chat with anyone about that offline.
Thanks, Mina. I know we're at 1 p.m. So if folks need to hop off, that's completely understandable. But if you want to stay on and ask Galen some last minute burning questions, we're happy to do that as well. I know there are a couple in the chat. Leila, I see that you've dropped in a couple of questions. So do you want to unmute yourself and ask Galen directly?
Sure. Thanks for giving me the platform. So I guess my first question is about social financing. What do you think about that?
Sorry.
The crowdfunding and.
Oh, I think as an investor, we're usually not that keen on seeing that type of funding on the cap table. Again, maybe it's considered old thinking on our part, but we almost see that as sort of a last resort type of financing or funding of an organization is going that route. So you might end up having, a smaller pool of potential angel investors, or maybe some would just say, I'm not interested in that. But it doesn't mean you as an organization, that might be the strategy you take and say, we're just going to go in this direction and go out and do that type of funding. The concern becomes, will the VCs, how do VCs feel about it? Again, as you as an organization, once you get on the, I like to call it the hamster wheel of funding, right? Once you get on that funding, you have to think about who's the next funder that's going to come along and give me the next check. And so part of that is, will VCs be all that interested in wanting to fund you? Now, if you've got a great company, if you use that capital efficiently and built up a company and de-risked it, there's probably not a real reason why any other investor might not jump on, right? It's up to you what you do with that capital to continue to de-risk your organization.
Perfect. And then, sorry, I'm just going to move rooms for this. My next question is about what if you're too diluted, like we have, a lot of people interested in investing, but for me, it doesn't become as interesting to, let them in. So what can I kind of negotiate in that sense? Like, can I have royalties, a bigger salary, or something else that, that I can negotiate if I'm giving all or almost all of my shares to this deal?
So that's a very good question, and that's also comes back to this whole idea of valuation, right? So if you think about your first levels of funding, you should be sort of thinking about, okay, rough numbers. First funding, I'm going to give away 15 to 20% of the company. The next round is going to be 10 to 15%. But inevitably, when you start to move along and get funded, a VC does not want to see a founder with less than 50% of the equity of the company or founding team, for the exact reason you just mentioned, which is you have less incentive. Well, if I'm betting on the founder, I don't want the founder to leave. So anybody who's trying to take too much out of your company at an early stage and trying to take 25 or 30% of your company in the first rounds of funding, you as a founder should be running away from that deal, because it's not in your best interest, and it's not in the best interest of the organization, because you may end up in the situation you're in. What typically will happen is if you move up the stack of investors into VCs, you'll have VCs that say, we can't have this. We want to fund this company. We want to recapitalize the whole company. We need to now go in and buy out original investors. Well, you as the founder now have to go back to some of your original investors and say, I need to buy you off the cap table. Well, some of those investors may not want to do that, and so therefore your deal could get scuttled. It may not happen, and you die, right, as an organization. Or you end up upsetting some of these early stage investors who took a big risk, and now they're only going to get double their money because the VC is saying that's all we're going to pay to get these people off the cap table. But inevitably, you're going to run into a problem that if you don't have enough skin in the game, you have no incentive and you might leave the company. And what are the investors left with, right? So, so if you're dealing with another round of funding right now, trying to move up the stack, and if it's a VC, then you should be checking with the VC. Do they want, is there an opportunity to try to do a recapitalization of the company, which keeps you with a larger number of shares? They just have to buy other people off the cap table to make that happen, right? And allow you to get more shares. But it's a big challenge if you as the founder suddenly have 20%, 15%, 5%, you want that level of ownership when you get public, right? When the company is really much further along, but you own 5% of a multi-million-dollar company, right? Like that's inevitably for $1 billion company.
So having a smaller pie of the bigger piece right now is not worth it. It's worth it if I'm going public, let's say, or at 100 million, let's say.
Yeah, exactly. So if your company, if your company is coming out now at or this valuation has your company at 20, $30 million, but you've got now only 5 or 10%. You're gonna, and that keeps going along. You're gonna get less and less and less every round beyond that. And again, as a funder, I would be really scared that you just walk away, because if you're a good founder, okay, I'll leave this and I'll start something else, and I've learned my lesson, and I'm gonna go build a new company. And now, as a funder, I'm left with a rudderless organization.
Okay, interesting. And then my last question was if you could even put it in a chat or whatever, it's like the best book for people doing this, for people to understand this, let's say, more at a intermediate beginner level, and then the next book after that, the book where it really gets you, if you have any references.
I don't have any off the top of my head at this point in time, but because I haven't read any recent ones, right? So some of them are a little bit, they're probably 4 years old, and 4 years in this world is stale.
Okay.
But I'll think of someone if I've got something, I'll either throw in the chat or I'll send it to you.
Perfect. Thank you so much.
You're welcome.
Awesome. So we'll take 2 more questions. Arnaud wants to know at what stage of the fundraise cycle a founder can ask for salary as part of the investment.
Oh, I think a founder should be trying to think about getting a salary as quickly as they can. It should be, if you're not getting a salary before your first raise, it should be built into your first raise. You should be now starting to get a salary. Again, we want founders that have an incentive to want to be working, right? There's nothing worse than spending day and night doing something and not getting paid for it, right? We want to make sure you can live. We want to make sure that you have the opportunity to be able to, either live on your own, eat properly, be healthy, all those kind of things, right? We're not callous people. Investors are, generally have been founders themselves or gone through these things, right? So I would definitely be thinking that in your financials, in the raise, you should be putting in your salary, and the salaries of your key employees should, be built into that initial raise if you haven't had the opportunity to, pay yourself prior to that.
Got it. Yeah, that makes sense. All right. And there's one more question in the chat. Stephanie wants to know, what did that group or venture do to make themselves investor friendly? I believe she's referring to the ones who were able to close the round within 2 months. But Stephanie, if I'm wrong, just unmute yourself and clarify.
That's correct.
So generally, those who can get funded faster are or have already have a lead investor, or they, let's say they're coming in, they're raising $500,000 and they've got 300,000 or 400,000 of soft commit, right? And they're just trying to now round out the rest of it. And if they can get their 500 of soft commit, then everyone will fully commit. What you will find, I think, in a lot of cases in the angel investment world is that if you tell me you want to raise $500,000 and you're going to do XYZ, the concern becomes if you only raise $250,000 or $300,000, will you be able to do X, Y, and Z, or are you only going to be able to do X, Y, or are you be able to do X, Y, Z at only 50%, right? So we as funders, we want to make sure you're fully funded, but we also don't want to commit a check to you until we know you've actually got all the $500,000 rounded up and ready to go. So if those ones that will move through the pipeline faster already either have a lead investor, they have some soft commits already to the funding round they want to have. It's been a warm handoff maybe from one angel group to another angel group. And the last one is it's a founder that's done it before. So we had a situation at York Angels where there was a founder who had a successful exit. He was building another company, came in, pitched, immediately got funding because everyone knew this person, right? They were a known quantity. Everyone was lined up and ready to go and invest in whatever this person was going to do, right? So those are the elements that are going to speed you through the process in an angel group. If you're coming in and you have none of those things, that's when it takes 4 or 6 months because you're starting from scratch, you're starting from zero, and that due diligence process has to start from zero, right? Versus, again, if you're a warm handoff from another angel group, there's already been due diligence done. We would often listen to the executive director from another angel group, and they would share that due diligence with us, and we could kick off our process much faster.
Awesome. Galen, I do want to be mindful of your time, but there are questions coming in the chat. Do you want to take them offline?
Yeah, no, I've got till 1:30, so I'm good.
Awesome. Perfect. Rima wants to know, does the age of a founder play a role in getting funding?
It shouldn't. Sometimes it does. I think that there is some ageism in the funding world. I think that in general, it's a little more difficult for older founders to get funding than it is younger founders. I think if a founder is 50 plus, maybe they've left a different cycle, a different working environment, starting their own company. It's a little more difficult because, again, as funders, we're looking for, hey, this might be a 10-year journey. Is this person at 50? Are they gonna be able to withstand the ride that this goes on, right? And it could be 15 years. Like, are they really willing to put in that effort and do that kind of thing? There's other elements around their life that you have to wonder about. Hey, when the pressure gets tough, or they've got to sink more money or time into it, are they willing to mortgage their house or do these kind of things at 50 when they're maybe thinking more about retirement, right? So there is a bit of an ageism around some of this versus, I've never really seen an issue around investing in a younger founder. It all comes down to, again, back to who is this founder? What are they all about? How do we see them as a driver of their business, and then what is the business? And so we may spend a lot more time with the younger founder trying to understand, what do they really know about the industry? What's their domain expertise? How are they at dealing with other people, right? If they built a good group around them, right? Do they have a strong network of people that can help and support them, right? So, but in general, I haven't seen age really be too much of an issue. I've seen, founders come through at all different stages. The sweet spot generally kind of 28 to 35. That's, I think, we've probably seen more founders get funded in that space, but I've seen, founders of all different ages get funded.
Got it. Thank you. And then Afis is saying, do you have a template for raising funds for term sheets and financial forecast?
I don't. I do, but they're not something we typically share. But there definitely there's some resource. I know there used to be a resource out there with NACO, the Common Docs. I don't know, Nafis, maybe if the Common Docs are still. Do you guys have a link to that?
We can check at our end, and Afis, we can put together some list and share with you.
So NACO had, in conjunction with a couple of law firms, this was about 7 years ago, created something called Common Docs. And these were a bunch of law firms got together and created sort of a standard set of templates around all different types of vehicles out there for fundraising. So if the Common Docs are still available, you might be able to find it through NACO, NACO, through their website. That's typically where I would have gone to find all that. And sorry, the second part of the question was?
That was it. He was just looking for templates for term sheets and financial forecast.
Oh, well, financial forecast, again, there's no common template for that because every business is different, right? So when it comes to, here's what I can tell you about forecasting, and again, my opinion on it. As a funder, I really care about the next 18 months. I really, somebody who tries to give me a detailed forecast for 3 to 5 years to me, is a waste of time. It's a waste of their time to go and do that because I don't know what's going to happen in 3 years. I don't have a clue. I don't know what's going to happen in 2 years from now. But you as a founder can probably see the next 12 to 18 months. That's what you should be focused on. And what can I accomplish in the next 12 to 18 months? Then you can make some extrapolations and have some higher level. Okay, here's what we think we'll be trending to. But to try to do detail around anything beyond 18 months, I think is very, very difficult for anyone to do, and really will probably be wasting more of your time than focusing on what am I going to do in the next 12 to 18 months. And likewise, your funding should be timed around that, right? So what am I raising, and what am I going to do in that next period of time? Try to marry those up, and if you can tighten that up as much as possible, a funder is going to see that you've actually been really quite thoughtful about what you're raising, what you're going to use the money for, and then how you can spend the money and the timing of spending that money. And again, it's far easier to see 12 to 18 months than anything different.
Yeah, thank you for that, Galen. And I see that Nafis has also dropped 2 links. One is for NACO Common Docs. So thanks for that reference. Perfect. So I feel like we're all caught up with the questions in the chat at least. So if there are any last questions for Galen, you can raise your hand. If not, we're good to wrap the session up. Galen, thank you so much. This has been incredible. It was super informative. And thank you for staying on to address all the questions as well. Really appreciate you.
Not a problem. Thank you very much, everyone. Good luck with your startup journey and fundraising.
Thank you, everybody. Really appreciate you.